I mean, what are we seeing here? On Friday, it was a better looking market, trading up in the green, responding to some kind of leadership around the Eurozone crisis, but not so today.
Yeah, actually on on Friday, sorry, what we saw was a market that looked like it was about to turn. I wouldn't really attribute it to the Euro crisis, but we have been seeing a lot of foreign investors in our market. I mean, they've been doing upwards of 60 to 70% of market turnover every day. What we saw on Friday was we saw a bit of locals come in, local fund managers come in and take up some positions. I think that really contributed to the movement we saw in the market.
All right, what's happening with the shilling? Still feeling some pressure?
I think what will happen with what we expect with the shilling, it will just trade range bound basically between levels of at the very most 91 and 89. There's still quite a bit of pressure, especially with what seems to be the central bank's loosening monetary policy. I mean, they were in the market last week through reverse repos. They were in the market today again through reverse repos where they pumped in about 19 billion. So we might see some pressure on the shilling this coming week, but we just expect to trade between the same range.
All right, let's talk about results coming out of equity today, because when the markets were subdued, we were told, it's because investors are just awaiting some kind of indication of company performance. Their results looking pretty good, 57% increase in profits after tax. We've seen them grow their loan book. We've seen them grow their investments. Is that an indication of just generally how banks will be performing?
Basically, I think with equity is a bit different. I think we might see this through equity and KCB. What drove equity's growth mainly was, I think the basic fundamental factor was growth in customer numbers. And this can be attributed mostly to the increased distribution network through the agency banking. I think so far only equity and KCB have implemented this. Equity being actually the bank that came up with the concept. So, I mean, they've implemented it throughout the whole country. I mean, it's very strong. It's brought in on board a lot of customers and with it customer deposits. And so, I mean, I'd attribute most of the growth for equity to that. And you might see a bit of that play out in KCB. But for the other banks, we'll just have to wait and see.
And I mean, what are we likely to see by way of trends in interest income going forward? We've seen the interest rate cycle change the tide. We're seeing inflation really weighing in heavily on Kenyan business and consumers. And there's just a sense that going forward, neither consumers are going to want to borrow and corporates are not going to afford to borrow.
I think basically what we might see is maybe a bit of, the private sector being pushed out from the credit market, because about 90% of all local banks have upped their base lending rates. And I mean, and also they've tightened their lending. So, I mean, you can't just walk into a bank and get a loan. They're a lot more stringent on who they lend to. And the level, the lending levels are a lot higher. So, interest income may take a hit somewhat. Also, we're seeing the same in inflation. With inflation being putting pressure on, for example, the real estate sector, we're also seeing a drop in property rates, and this will affect the number of borrowers going to the bank to put up real estate.
Before we talk about what's happening on the real estate side, the fact that banks largely constitute the institutional investors into the bond markets, even if their figures are looking good for the first half, going forward, are we likely to see them investing in government treasuries? Because we've been told, with the pressure on the shilling recently, many just want to dispose of those assets.
Basically, what we've seen, of course, since the beginning of the year, yields have shot up on treasury bonds. This has led a lot of investors have lost value on their portfolios. But most banks actually, I think we should see most of them taking a hit in this during these results. So going forward, I mean, there's fresh money coming in. This is actually the best time for institutional investors, individuals, retailers, all to come into the fixed income market, because these are not trades you'll see again. They might hold for the next, let's say, between 12 to 18 months. But going forward, these high rates are not sustainable. So we do expect the market to turn. And I think we'll see a lot of, especially banks, once they get their house in order, once they've taken care of their revaluation losses from the portfolio they built up in 2010. we should see them coming back to the market, maybe towards the last quarter of the year, because these are rates you take advantage of, and especially the T-bills. I mean, that's a very good example.
Right.
Of course, a lot of banks have been staying in the short end because of volatility in the market, but once these rates seem stable, I think we'll see a lot of investors coming in.